a guy who's a master with the charts. We've got him on the phone right now. Dan Shaffer also has been very cautious, bearish on this market. Dan, is this the tipping point that you've been looking for?
I believe it is, Charles. I've been talking about it for the last month about this chart from 1929 to 1937, and we have the exact same correlation. It's about 95% correlated.
1929 to
1929 to 1937. In 1937, the Federal Reserve raised interest rates thinking that they were coming out of the Depression. And at that time, the economy just couldn't handle it, and the stock market dropped about 50%. So that's what I see happening here. I've got a chart. I've sent it over to you. I don't know if you could use it. Maybe tomorrow when I'm on, we could show it. But there's a very high correlation. So I expect this current drop that just started, because we broke through Monday's low, technically to last till October 24th of this month. Then we'll get a little bit of a bounce. But now we're going to, as Jeff Sika was talking about before, we're going to get lower highs and lower lows.
Well, you know, 1929, it took, I think it was like 1942, 43 before the Dow broke even, right? So we went through 12 years. But in between there were a lot of bull markets and bear markets, up 20%, down 20% kind of thing. You talked about the Fed's role in all of that. Is that where the real mistake is going to happen? The Federal Reserve, have they been raising rates too much already?
Absolutely. Absolutely. There's no inflation out there. Everybody keeps talking about inflation. It's not happening. If you look at commodity prices, they've been depressed and continuing to move lower into this current month. And now they're starting to turn up, which is usually what you get at the end of a growth cycle. But with the numbers of the GDP coming out, which I've said to you several times, I believe they're going to go negative. I think that the world growth situation is tapped out on a financial basis based on the amount of debt. It just can't be serviced. Revenues coming in from taxes has declined. How's this all going to be paid back? It's impossible. So the market, let's go back. 1929 is similar to what we had in the bottom here in 2009. And then we go to 2018, which is similar to 1937. And that correlation just says the Fed raising rates, and, you know, the Fed's been wrong since 1913, into an era where they think they're getting ahead of the curve when they're actually destroying the curve. And that's why if you look at the yields between the 30-year, the 10-year, and the 2-year, that they're very tight and they're declining to go to an inverted, meaning the long-term rates will go below the short-term rate because he keeps raising them.
And that's your ultimate sign of recession, and, of course, 0% GDP. Well, that won't be this quarter, but you're saying it's going to be soon.
Can we just take a breath? We're just at the beginning of September levels, right? We just wiped out a month's worth of gains. I mean, I hear what you're saying, but the federal revenues, by the way, income tax revenues, forgive me, are coming in pretty strong due to the tax cuts. And so the question is, what has got the markets jittery, and to Ashley's point, twitchy? It's looking to 2019. What is the markets trying to digest? It's higher rates, it's higher tariffs, it's the trade implications, and it's weaker foreign currencies and a stronger dollar.
Even without any of those things, we know that 2019 is going to be tough with respect to comparisons.
That's
we cannot match the magnificent revenue and earnings growth that we saw this year. And that's something I think every investor already understands. But what you're talking about, Dan, is cataclysmic. You're not talking about just, hey, you know what, earnings were up 26% in 2018 and they'll be up 20% or 10%. You're talking about a complete economic implosion.
Well, Charles, I don't want to be severe of an implosion. I'm not expecting a 1929.
Well, when you bring up 1929, what else can we expect?
I mean,
but hold on a second. Now, the stock market is a predictor of the future. So with the earnings that are coming out now, the stock market has already predicted. So now the market's going to start to predict the future. And that's what is ahead of the yield curve.
All right. Dan, we're going to let you go. But 2 weeks ago, the Dow was predicting an amazing future where it was going to be sunshine, blue skies. We were at all-time highs on every index. The transpos went through the roof. But I get you, and we always appreciate your point of view because you do some serious, detailed work, and we like hearing it. Thank you very much.